Good morning, everybody. Appreciate y'all sticking around. And first of all, before I get started, I want to thank everybody for coming to the conference. Thank everybody. I know I travel a lot, and I know traveling is not back up to where it should be. So we really appreciate you being here. Obviously, we had record numbers, had to open up the wall yesterday, so that was good. And appreciate the folks who are coming in from online. Understand there's still challenges with travel. I'm glad that through the pandemic we've started this ability to broadcast out, so hopefully those of you looking in are getting the benefit as well. And as always, we record these and we post these to the ACES website, and you can go back and watch them over and over again, which is a real thrill for my children. They love watching my presentation. So I think a couple of common themes that we've seen here over the past couple days are this quick transition from a fossil fuel-based grid to a more intermittent renewable grid, and that's obviously something that we've talked about every year for the past 10 years. It's just actually accelerating now, and we're seeing that impact a lot greater. We have, as we heard from the speakers this morning and from the past couple days, we have relied on natural gas through this transition, and we continue to rely on natural gas. And then third, there's a concern about reliability, and there's a concern about prices. And I'm not really going to talk about reliability. I think we had the experts here on that yesterday, so I think we've covered that. I'm going to talk about prices. Now, I will tell you, a number of people last night and this morning did ask, they did say that, it wasn't very uplifting yesterday, and they were hoping that I was going to bring some good news. So if you want to act like your flight is leaving early and just get up and leave now, I can't even see you with these bright lights on, so just tell me you're here and we're good. So anyway, with that, typically we have a commodity price outlook during our presentation. We haven't really talked about that yet during the members conference, so I'm going to do that myself here. And I've got about 40 slides, but they go quick, and I'm going to talk about mostly natural gas because I think that's what's driving a lot of the increase in price and volatility we've seen. And so the big question is, are natural gas prices going to come down? Are they going to be less volatile than we've seen? And as a direct impact of that, are we going to see wholesale electricity prices do the same? So we'll jump in here. If I hit the right button, just the green button. There we go. So here we are, shift to natural gas renewables continue. So this chart we show basically every year. You see it in a lot of conferences you go to. And it just showing, if you look back, a huge jump in natural gas usage, renewables continue to increase, coal and nuclear as well continue to decrease. So this is just a picture of where we're at today as a continuation of what has been going on for a decade. I will say, as a preface to this, we have built a lot of renewables, and it hasn't really caused an issue in a lot of areas. And a primary reason for that is because of the low-cost, abundant natural gas that we have had over the past decade, primarily of growth out of the Marcellus Shale in the Northeast. And so this trend is not new, but this trend has been greatly disrupted by a combination of increased natural gas prices and, as we'll talk about, a decrease in traditional capacity such as coal and nuclear. So is my clicker not going to work? I think I got help back there maybe. So over 50 gigawatts of new supply under construction. And this is similar to the queue discussion that we had yesterday with a couple of folks. And if you look at it, and this is actually under construction, so this isn't in the queue, but if you look at it at that 50 gigawatts, it's solar, it's wind, and it's a little bit of natural gas. So this is just saying that we're going to continue on that path that we've been on as we look forward. Somebody got me back there? I'll just say next slide if that works. I don't think I'm doing anything here. So we'll look at natural gas prices. This is a chart of the past year. So we heard a lot of talk about 2030, 2035 going down the road. What we're going to do is we're going to look back 1 year, basically, kind of what happened over the last year, and then we're going to look forward, maybe look through 2025. So I'm not necessarily going to say what's going to happen to gas prices in 2030, 2035, but a little bit more shorter term look and what we can expect. So if you look back, May 21, that was our last members conference. This is the NYMEX Henry Hub gas price, and as Marcus pointed out earlier, the gas price at individual locations varies widely based on transportation cost and supply and demand in that area. But this is the price you'd see in the Wall Street Journal or on the news when you watch that in the morning. And last year it was $3 per MMBTU, and we were kind of in an environment where we had talked about California, and we had talked about Texas and the things that had gone on there. But in general, the NYMEX natural gas prices hadn't reacted to that much. And here now we're at 14-year highs. So we traded over $9 per MMBTU this week, I'm sorry. So we have seen natural gas prices triple in price just since our last members conference. And on the next slide here, we'll look at supply and demand fundamentals. This is really what's driving that price. This is a little bit of a busy chart, but basically it says that supply and demand fundamentals are out of balance. So on the first block there, you have supply. So production year over year is up 4.4 BCF. Now that's a little bit inaccurate because that hasn't been new supply growth necessarily. As you'll recall, a year ago, we had a lot of supply disruptions with the Winter Storm Uri and that sort of thing. So a lot of this supply growth year over year is just reflected in the fact that production was down so much last year, and we've come back this year. If you look at the demand, power burn up 2.4 BCF, pretty significant. LNG exports up 1 BCF. This is really the thing that we're going to talk about is LNG exports. But if you look at it all in all, the balance is out of balance. So year over year, total supply up 4.5 BCF, total demand up 5.4 BCF. And when you get that, you get a imbalance in the natural gas market. We talked about supply and demand with the economics speaker yesterday, and certainly storage plays into that. We'll talk about that. But overall, you get this picture that we're not in balance. So in the next slide, we look at the natural gas demand based on different sectors. And a little bit of a busy chart here and a little bit hard to read. What I want to point out to you is that if you look back historically, that light blue bar sort of at the top below the orange is net exports to Mexico. That was a pretty big conversation piece a few years ago. It's held pretty stable, if not grown just a little bit. That light blue bar is LNG exports, and LNG exports have certainly led the charge on demand. On this next chart, we look at the peak capacity for LNG exports. So a few years ago, we started saying, hey, we've got low-cost, abundant supply of natural gas in the U.S. It's $2, $3. We're going to build LNG export terminals and ship this to other parts of the world where gas is trading $10, $15 per MMBTU equivalent. And so we started building export terminals. Well, we've built them to the point where we're just over 12 BCF a day of export capacity. We said back when we were building this that we would end up being the swing supplier to the world. So as the world needed gas, we would export our low-cost gas. As they didn't need gas or as we needed it, we would swing that back down. I'll show you in a minute that we don't really swing that back down. It's been pretty elevated, but LNG export capacity has accelerated, and we've seen that, and we talked about that yesterday with the challenges that Europe is having, and it's a little bit of a challenge because the current administration and sentiment in the U.S. has been to reduce gas and oil drilling and to reduce the construction of natural gas pipelines, which we heard Jim Robo talk about yesterday. And at the same time, we've decided that we're going to save Europe in their gas issues over there with Russia. And so we're actually accelerating LNG export capacity additions. FERC has approved the first one in a number of years, I believe, since the new administration's in place. Last week, there are plans to have some quick-built LNG export facilities that will add to that. So the moral of the story is, keeping in mind that right now we're producing about 95 BCF a day, billion cubic feet a day of natural gas in the U.S. The export capacity at the end of 2022 will be 14 BCF a day, and that will continue to increase. So if you look at the next slide here, these are global natural gas prices converted to MMBTU. And if you look here, Henry Hub, the U.S. price, is that little blue line right there at the bottom that you can even see with the volatility that I showed you is very, very, very minimal compared to the global prices in Europe and Asia, where through a combination of things, I mean, Europe was initially having some weather concerns, and there was demand out of Asia prior to anything else going on. So there was a global demand for LNG. The U.S. has become the largest exporter of LNG to the world, and you can see here that LNG prices around the globe got up to $60 to $70 per MMBTU. So you can see there where there's a huge incentive, if you're in the natural gas business, to not sell your natural gas in the U.S., but to export it. So on the next chart, I've layered over the total baseload capacity, which you see there, which we just showed, which goes up to current, which is about a little over 12 BCF a day. And then you see gas deliveries to LNG plants. So you can see here that it's not like we are balancing the globe. We're just sending as much gas as possible out. You see a big dip there. That's, of course, the beginning of the COVID pandemic, where everything global shut down just for a brief time there, and gas did remain here. But for the most part, you see that LNG exports, actually natural gas transportation to export terminals exceeds the capacity. Now this is to show that we are, yes, indeed, utilizing all that capacity. The reason it exceeds it is because the LNG export terminals can actually run at a higher capacity than their rated capacity if the global market is hot, which apparently it has been since we started exporting gas. And also there are fuel storage facilities at LNG export facilities so that they can liquefy more gas as ships are coming in and out. So that's the reason for that. So that was the demand side, and it's primarily been driven by LNG exports. We have said, and a lot of people have said over the years, that at the point where the U.S. becomes the largest exporter of LNG, natural gas will no longer be a domestic product where we basically have all the supply and all the demand balanced within North America, but it will become a global commodity. And just like oil has always been, and just like we've seen coal over the past 15, 20 years, as global influences impact the price of the commodity, wherever it is and whatever is going on, if we have the ability to, as a country and as the LNG natural gas and LNG exporters have the ability to take advantage of that, they will, and it will affect our domestic prices accordingly. So that's the demand side. On the next slide, we have a familiar chart on natural gas supply, and we've talked about how natural gas supply is limited. Almost all of the growth that we've seen from the shale boom in 2009 to right up to where COVID hit was from two areas. That was the Marcellus Shale, that's the green up there in the Appalachian Basin, and then the Permian in Eagle Ford. Now, the Marcellus is mostly what we've done there is dry natural gas. The Permian and Eagle Ford are crude oil fields primarily, where they're drilling for crude oil, and as an associated product or as a byproduct, you get natural gas. So if you look back at like 2019, there was so much natural gas coming out that it was actually priced at a negative price in West Texas. So it's quite a swing. I was once told when we were talking about hedging gas at $2 that what if it goes negative? And I was like, it doesn't go negative, but it did. for a short period of time, and that was because of the oil drilling. In between those two, I'm going to talk about this one too in a minute, is the Haynesville Shale, and that's in eastern Texas, Louisiana area. That is a dry gas play that has been pretty quiet because it requires a little bit higher gas prices for $4.50 per MMBTU historically to produce natural gas. It's a big shale play, and it's got a lot of gas, but it, again, has historically been quiet, and we'll talk about that one here in a minute. So on the next slide, if you look at drilling, and we've talked about ESG, and it came up yesterday on what the pressure on natural gas and oil producers is having on their drilling. You'll see that drilling is picking up, but when you're talking about $9 gas and $110 crude oil, you would expect for it to be going out the, going to the top of that chart. And there's a couple things going on. There's certainly the manpower to do it, which we've talked about in every industry. There's the cost of everything from trucking to fracking sand and that sort of thing. But what's really driving it is with the big publicly traded oil and gas companies, for years and years and years, their metric, what they were rewarded for in the stock market was drilling. And so regardless of what the price was, you've seen it, drill baby drill, that was what it was. And so that kind of came to an end here a couple years ago with the ESG talk coming up, and the stockholders, a lot of activist stockholders or big pension funds. BlackRock was a real vocal group that was saying, hey, if you're going to be in the oil and gas or the coal business, we're not going to invest in your companies, in our pension funds and our managed funds. BlackRock, interestingly, is, according to the Wall Street Journal, the largest holder of coal stocks over the past year, which are up 5,000% as a group. So maybe they were, working the system there. But regardless, the big oil majors have instead invested in green businesses, and they've taken that money and they've returned it to stockholders, and that's where they're getting their rewards from in the stock market, as the oil and gas stocks are doing quite well, or they were. The other thing too is that there's a general push against oil and gas drilling in the U.S. from the administration, and just because gasoline is $5 a gallon now, and the administration is asking the oil and gas companies oil companies in this case, to start drilling, they're not necessarily excited to get back at it, knowing that once they over-drill, which they tend to do, and prices collapse, that one, they'll probably get hit with a windfall tax for making so much money, and two, they'll go back to getting beat up for investing. So it's a challenging business. But we are seeing the small, I'd say mom and pop, independent oil and gas companies drilling, and Jim Robo talked a little bit about that yesterday in an article, pretty good article in the Wall Street Journal that kind of describes the life of a small-time operator in the oil and gas business. The particular one, the article was about, the guy was kind of bankrupt a couple times, and now he's a billionaire. So hopefully he'll sell his business, but probably not. The rise in this on the next slide here is offset slightly by drilled but incomplete wells. And what these are is that when times are good and they're busy, they're drilling wells and they cap them off. They don't bring them on right away because of pipeline capacity or prices or other reasons. Well, you can see running up into kind of the pandemic, these drilled but uncompleted wells were growing, and mostly, again, that was in the West Texas area. And these two charts are oil and gas combined. Most of this is West Texas, and therefore, with the oil, you get the gas. So keep that in mind. So that increase in drilling that we're seeing is being offset by this decline in these what they call DUCs. And so we're not necessarily going to see, in my opinion, a big increase in production because of that. So on the next slide, you wouldn't think that's the case because it doesn't cost $100 a barrel to make a lot of money. I think John Baer might have said it yesterday, 40% returns on oil and gas drilling. Obviously, the ones that are doing it are making a lot of money. Crude oil prices are currently, I didn't look this morning, but I think around $110 a barrel. Again, I've discussed the challenges that we've had with producers wanting to produce, to invest in producing. Oil prices are expected to remain elevated. That being said, at this price or even at $80 or $60, West Texas crude oil is very profitable. And so we'll have to keep an eye on that, because on this next slide, if you look at it, we haven't seen the rebound in production that you would expect with that $100 a barrel crude. So we were at 13 million barrels a day, which was an all-time record. Pandemic hit, obviously everything tanked. Crude oil did also trade negative for a short period of time, and in response, production dropped significantly. We're up about 1.5 million barrels per day, but not anything like you would expect from a price environment that we're in. So if you look at the next slide, if you take the associated gas from crude oil drilling, which isn't recovered, and you take the natural gas from the Marcellus, which we'll show in a minute is limited by pipeline developments, production in natural gas is not keeping up with demand. So at this point in time, as we stand here, we expected over 100 BCF a day in natural gas production. If you look back prior to the pandemic and the drilling collapse, Winter Storm Uri, which we talked about last year and had a lot of impact on natural gas production, Hurricane Ida, and a couple other events. So Mike mentioned it yesterday. We were running around 93 BCF a day. We did jump up to 97, 98 BCF a day, back down to 95. So we haven't really seen a big increase in natural gas production despite where we're seeing in prices. Where historically, again, we would have seen a pretty quick response from producers, kind of, finger on the button, ready to go. Now we'll talk about coal here in a minute on this next slide, and coal's role in stabilizing prices. So back when we had way more gas than we were ever going to have anything to do with, and we hadn't had the export capacity yet to send it overseas, we were like, what are we going to do with all this natural gas? I mean, you can store it, but you can only store so much, and we store it for winter. Natural gas prices, as you may recall, got below coal prices. And they did that to incentivize greater burn of natural gas for electric generation. And the coal backed off, and we soaked up all that excess natural gas that we probably wish we had back now. What happens, though, when we had an event in the gas market, whether that be a hurricane or a freezing event or just high demand, natural gas prices would start to come up, and they would get back above that coal price, and the demand for natural gas would fall, and natural gas prices would fall accordingly, and it played that little game. Well, this is a chart of cap coal and Henry Hub gas converted based on a bunch of assumptions to dollars per megawatt hour. And you can see here over the past year and a half that natural gas rose above coal. Coal burn did go up as a response, but because of the current fleet where we've retired over 100 gigawatts of coal in the past decade, there's not as much capacity to be able to switch that. So that historic coal and gas switching capabilities that we had that kind of kept both commodities in check, because of the lack of capacity to run the coal, that didn't help out with natural gas prices continuing to increase, because between the power generation sector and the LNG export sector, the demand was there. So the other thing with coal, and you can look on this next slide here, is that coal stockpiles at coal plants were at all-time lows. We were talking yesterday, one of the plants had 6 days of coal. And so you have a situation here where as an industry, we were going to retire a bunch of coal. Over 100 gigawatts last decade, forecast 100 gigawatts this decade. So if you have a coal plant that's on its way out, you're probably not going to keep 120 days of coal there. So the coal stockpiles were dwindling. The coal mining industry was ramping down. Coal companies were going bankrupt. We were getting out of the coal business. And then as we saw natural gas increase, there was an issue there where people were preparing for this upcoming summer, and they're saying, hey, I'm going to keep burning gas because I want to make sure my coal stockpile gets back up to where it needs to be. Now, one of those is strategic. The other problem is the same problem that we're having with baby formula and other things that we need is transportation and shipping. So if you have a mine mouth coal plant like some of you do in here, you just put the coal into the plant and there you go. But if you have a power plant in Georgia and you have coal in the Northwest, PRB coal, you have to ship that by rail to get it there. And the railroad industry is facing the challenges that everybody else has with staffing and just the ability to fight with the toilet paper industry for shipping and that sort of thing. So there are challenges that have limited that. So if you look at the next slide, if you put the coal market together, coal demand has gone up significantly. We do still export a lot of coal. There are a lot of other countries that still burn a lot of coal and like our coal. The U.S. coal consumption has gone up significantly. The production has lagged. And again, it's the same story. It's like, do I want to hire 300 people who are likely not trained, train them up, open up a coal mine, start mining coal again? That in itself doesn't happen in 3 to 6 months. But all in all, if the long-term outlook is a challenged coal market, so that's the challenges we have there. So if you look at the next slide. Because of the demand response from the power sector and because of the lagging supply response in the ability to mine, we saw coal prices like skyrocket. So if you look at this chart, this is just over the past year and almost a half. And these are global prices. So you've got European prices and then you've got U.S. prices on the right there. But just so you don't have to get into the details, let's just look at Illinois Basin coal. A year and a half ago, it was $30 a ton. Now it's $130 a ton. So even if this incentivizes producing more, if these prices stay elevated as we tie it back to the gas market and wholesale power prices, that ceiling that we have historically had for coal to gas switching is going to be higher. You take all this together on the next slide, and coal, gas, renewables, all playing their part. And we haven't really talked about renewables. Everybody here knows they're intermittent. So, they're on or off, depending on whether the wind's blowing or the sun's shining. You put that together, and you get wholesale power price volatility. These are different points from around the U.S. If you look there and you go back, we started in January 20. That first big red spike is California, and we said, hey, California has issues. We should talk about these. And it was isolated to California. That next block, which impacted most of the country, Winter Storm Uri, ERCOT gets most of the publicity about it. And these are monthly averaged prices, so the daily price was a lot more volatile. You wouldn't even, it would have just been crazy to put on a chart. But that monthly ERCOT price, in order to look at everything else, actually goes up to $1,485 a megawatt hour for the average. We've talked about that. But then if you look forward, you see all the other markets, again, on the monthly price, experiencing significant volatility, and that's around intermittent renewables, natural gas prices that have been extremely volatile and high, and challenges in the coal market, which have led to coal prices there. So if you take all that and you look back, you look forward, and you go, all right, so natural gas prices are going back to $3 next year, and this is all going to go away, and everybody's going to be happy. But But if you look at the next slide, we'll go out, and this projects through 2050, but the commodity part of that we'll look at a little bit shorter term. But basically, this is what we were talking about yesterday, John Baer and others, of the queue. The capacity additions are all wind and solar and natural gas. So inasmuch as what we've experienced over this past year with this transition, if this is what we're going to continue to build, lacking some new technology or some new baseload generation, we are going to continue to experience the same impact in the wholesale power markets if we're relying on natural gas and intermittent resources for our generation. If you look at, so the intermittent resources are what they are. If you look on the next slide at this forecast through 2025 of natural gas demand, we are going to accelerate LNG exports. We are fast-tracking LNG export terminals. They are building them quicker. They are expanding current ones. We are going to burn more gas in the power industry. We talked about the economy yesterday. The world has come out of the recession, or the U.S. has anyway, at a very accelerated rate, causing an increase in demand in the industrial sector. With the headwinds we have now, will we see that much growth over the next 3 years? I don't know, but it's not a big significant part of it. Residential, commercial, exports to Mexico. All this together adds up to 11.5 BCF a day of expected growth between 2021 and 2025. So that's your short-term natural gas demand. If you look at the next chart, the supply side, and this is a consultant that we use that provides these forecasts that have massive Excel spreadsheets where they crunch all this data and come up with these. So that demand forecast and this supply forecast are from the exact same consultant. 11.5 BCF increase, just over, let's even call it 9 BCF increase in supply. So you can see there that based on these forecasts, and these fit with the other things that we're seeing, the supply is still lagging demand. And that top green line there is associated gas. So as long as we see crude oil drilling come back, we'll see that gas come. If we don't see the crude oil drilling come back, that gas won't be there. That next line, the blue one, is Haynesville, and we talked about that. Haynesville is a dry gas play, very profitable, ramping up quickly right now, could come to the rescue. We'll see. That orange one is the Marcellus, that's the Northeast. It's not really growing. And as Mike and some others joked yesterday, at these prices, there's probably 500 years of gas up there, and there probably are. But if you look at this next slide, and Jim Robo talked about this yesterday, and their experience on building a pipeline out of Marcellus, it's just impossible to do these days. So this is a historic look back of pipeline development. Most of it that has been built in recent years and is being built is, again, in the Gulf Coast, as was noted yesterday. Unfortunately, also, the LNG export terminals that are being built in the Gulf Coast. So I don't know if it's a come to save the day that the pipelines that are getting built are probably going to be export pipelines for the most part. But the point is that all the gas, the real gas supply, is in the Northeast. And without any more pipelines being built, it's just hard to see that supply keeping up with demand. If you look on the next slide, global LNG prices, this shows prices before the invasion in Europe and then after. And so I think somebody said, if things calm down there, global rest, what have you, LNG prices globally will come down, which will put some relief on us. The prices before were $25 per MMBTU, so it's very profitable to ship that. Even now at $50 or $60, if they come back down in half, the global LNG market is still short. So I would expect that whatever export capacity we build from the U.S. will be highly utilized to transport that gas elsewhere. On the next slide, if you look at coal prices, hey, if coal prices come down, we start mining more coal. Maybe that will offset some of the gas. Maybe we've talked about delaying coal plant retirements. Maybe we have enough capacity. Even if we keep the coal, these are forward curves in the coal market right now. And you can see there on that left column, we were talking about Illinois Basin before, about $130 per ton. You come down and it's still $80, looks like $85. So well above the $30 we experienced, and much higher ceiling for natural gas if we were able to burn that. So then on the next slide, if you look at forward natural gas prices, this is the forward curve from January 1st of this year, March 1st of this year, and then May 18th. So slightly dated, but pretty accurate. You can see there that forward gas for the balance of this year and next winter is very elevated. So the next 6 to 9 months, this is again Henry Hub. If you're up in Marcus's territory, you're going to have a lot of transportation up there. Prices might be even more elevated. It'll be different in different areas, but this is Henry Hub, very elevated for the next 9 months, and then it shows it coming back off to the $4 to $5 range, so that you could go out and you could lock in these prices right now. You could do this financially, and I think this panel did a great job of talking about some of those services. But most of the forecasts that we've seen are above this. And on the next slide, I think if you look at the actual market and the options that are trading and the volatility numbers out there, the general market expects, based on options trading in the NYMEX product, the market expects a lot of volatility. So even if we see overall gas prices, so maybe that's the good news, gas prices are $9 now, maybe they're $5 for the next 3 years. The point is that I think based on the supply-demand fundamentals and the intermittent resources and weather events and those sorts of things, you're going to see a lot of volatility around the gas price. And again, these guys did a good job. Being in charge of business development, I'm just going to show that video from now on. So I'm not going to tell you that too much, but that's something that we obviously help our members with, mitigating that risk. So that's something that you can actually look at. On these next two slides, it's a little interesting. It's a little shorter term, but I wanted to show these about why I think some of that volatility is going to be there. That blue line is production, so it stays relatively stable through the past year. If you look at that other color line, green, I guess, it's total demand, less exports. No LNG, no exports to Mexico. This is typically what we do. We fill up the gas storage in the summer and we burn it in the winter, and that kind of balances everything out. On the next slide, if you add LNG exports and exports to Mexico, you can see there that we don't have enough gas right now to store up for winter. And so you could see a situation where the gas supply for wintertime won't be where it needs to be, because during the summertime when we normally keep it in the ground, we're exporting it to other areas of the world. And on the next slide, you can see the current natural gas storage is well below average. So this is a 5-year min-max range of natural gas storage in the U.S. domestic. The 2021 line kind of ran right along the 5-year average, but as we've gotten into this supply-demand fundamentals mix, we've seen storage drop. So 10 years, not looking at 10 years, maybe not even 5 years, definitely the next year as we head through next winter, if we were to experience any sort of weather around next winter, this is going to be an issue with natural gas supply. And again, if it's trading $50 per MMBTU elsewhere, a lot of that's on shorter term contracts now, so we do have the ability to pull that back, but that means that natural gas prices have to get to less shipping and liquefaction and that sort of thing, have to get to basically $50 per MMBTU to incentivize it to stay here. We've seen that. We've seen that on the East Coast. We've seen that in different parts. We've obviously seen that in ERCOT, but that wasn't really incentivizing LNG. But we'll see that dynamic playing forward. Just to add to the volatility, on the next slide, the NOAA is expecting a above average hurricane season. So they're about 2/3 forecast above normal. So this just came out in May here. And so we don't get as much natural gas as we used to from the Gulf, but we still get natural gas from the Gulf. And when we saw Ida come through and knock out 1 BCF a day, the market is so tight that if any storm comes through there, and I think that's what happened when we saw the production here last week go from 98 back down to 95, is there was a storm in the Gulf and they do, shut-ins and stuff just for safety. So that's that. Back in Katrina and Rita days, it was huge. It became less of a big deal, more of a demand destructor. I think the gas market is so tight now that if we get a big storm in the Gulf, that's going to be a big warning sign. The next one here, Jim Robb yesterday talked about the drought in the western and southern U.S. He mentioned affecting, cooling for thermal plants and that sort of thing. The one thing that it will definitely affect is hydro supply. And we have a lot of customers and some members out west, and the hydro supply is expected. If you've seen the bodies and the barrels that they're finding in Lake Mead because the water's so low, the West relies on that water to generate electricity. And if it's not there, they're going to have to get it from somewhere. And they're going to probably try to get it from natural gas. And we saw that situation back in a couple years ago when the West was very hot and impacted natural gas prices all the way across the country because of that. Just real quick on the next slide, even if we do build out a bunch of renewables and they come to save the day, as they currently sit, they're intermittent. This is the duck curve. This is something that you guys have all seen. It's sunny during the middle of the day, and we talked about it yesterday when the sun goes down and people come on and the lights come on, the demand curve causes prices to spike. So we will see day-to-day volatility in this market as more renewables come on. That being said, besides just the fundamentals or just the day-to-day volatility, the underlying fundamentals on the next chart, and I think Jim Robo covered this yesterday, so I just wanted to highlight it. One more chart there. There you go. The cost of renewables are increasing. So they were declining for a long time. They were forecast to continue to decline. Last year was the first time it cost more. There is huge demand. There's cost for the inputs. There's shipping costs, as we know from logistics. There's the war in Ukraine. There's the anti-dumping issue that's causing a big shortage. And I've talked to a lot of you in this room about PPAs that you signed 2 or 3 years ago and how those are the counterparties coming back and saying, hey, we just can't do it for that. So we're seeing the underlying cost of renewables. We'll see that shift up the cost of wholesale power in general. So aside from the volatility, that as we rely more on it is expected. Now, we heard some comments yesterday that cost curve, everything will sort itself out and come back down. And yes, by 2030, very well maybe so. But again, looking a little short term here on where we can expect wholesale power prices. Next slide is about storage. We talked about storage yesterday. I'm not going to get into it. We need an awful lot of storage to fix the issues that I've talked about. The problem is that storage is having the exact same problems as renewables, getting the materials necessary, building them, shipping them, getting them in. So again, yeah, by 2030, maybe $4 a kW, maybe we'll have so much storage that it won't matter and we'll never build another gas plant again. But in this short term that we're talking about here, this storage is not going to come to the rescue in the short term. Next slide, I'm not going to talk about this at all because we talked about this quite a lot yesterday with John Baer, but it was the increasing in capacity prices. Now this is just the MISO example that Mike and John talked about yesterday, and I think that the message here is that capacity in general, while there was a debate on whether capacity is capacity more, but I think what this is kind of saying is, hey, capacity that we can operate and control and we know and we can dispatch is going to become more valuable than it has in the past. And we saw this time period here in the last 5 years where we have retired a huge amount of controllable capacity with basically no regard for the future other than renewables are going to solve everything. And so this is just a good example. I think that, you know, this is the first time in the past 10 years we've really been talking about all these issues that we've seen kind of at the federal level, and FERC and NERC and different things where people are like, oh, wow, there's a problem. So so that's good. That's good, I think. And I think at least hopefully will help at least slow down some of the pain that we've seen. So 2 more slides. The next one of power prices. This is a forward curve. I show this every time I give this presentation. And these forward power prices from different parts around the country are significantly higher than they were last year. These are actual forward power prices, 7/24, wholesale power prices around the clock for the next few years. And when we looked at this chart last year, they were between $30 to $50 for the most part on these. And you can see there, like probably SPP South, the lowest is like 40 out on the curve. And you certainly in the short term, we're well over $100 per megawatt hour on around the clock. So these aren't just peaking. So I do think in the short term, based on everything we've talked about, we're going to see elevated power prices. Around that, on this next slide, I think we're going to see volatility. And this is the monthly price. So, you know, you see the winter. The real extreme one there is out west with all the issues they've had. But nonetheless, we're seeing higher prices, higher power price volatility. I don't think in this next couple years that there's going to be any aha, we were wrong. I think we're going to continue to experience that. That being said, as was talked about with this panel of folks up here before I came up, and as many of you know from discussions with us, there are things you can do to mitigate this risk. And so I won't give you a sales pitch, but that's what we're here for. So we can certainly help with that. So on the next slide, I know I told you I'd get you out of here at 10 o'clock. Typically, we would have a break now, and then everybody would leave, and then I would get up and speak, so I kind of snuck one over on you. So we're done here. I'll take any questions. I'll be around afterwards if people want to get out, but either way, I'm good. I don't have a flight to catch, so I'm golden. And if there aren't any questions, I'd just like to thank everybody and really appreciate you coming out. We'll see you next year.